Have you ever dreamed of a future where you don't have to worry about work, where your income comes passively month after month, no matter what you do? It may sound like a fantasy, but the reality is that many people are achieving it thanks to a simple but powerful strategy: living off dividends. Now, the million-dollar question is, how much money do you really need to achieve this lifestyle? We are not talking about impossible amounts, nor about a luxurious lifestyle beyond the reach of most people. We're talking about the minimum amount that would allow you to cover your essential expenses and live in peace without depending on a salary. This video is going to break down exactly what you need to know to build a dividend portfolio that works for you. We'll dive into the amount of capital needed, investment strategies, and some practical tips to maximize your passive income. So, if you've ever wondered how it's possible to live off the money your investments make, stay with us, because the answer might be closer than you think. Are you ready to discover the magic number? To start, we need to briefly explain what dividends are. A dividend is a portion of the profits that a company pays out to its shareholders. It is as if you owned a small fraction of a company and, as an owner, received a proportional share of its profits. These payments represent a reward for investing in the company and are a way to generate passive income. Not all companies pay dividends, but those that do tend to be large, stable, and financially sound, such as banks, energy companies, or technology giants. Some of the companies with the best historical dividend yields include AT&T, known for its high dividends in the telecommunications sector; ExxonMobil, a giant in the energy industry that has maintained consistent payouts to its shareholders; Coca-Cola, which has increased its dividend consistently for decades; and Procter & Gamble, famous for its stability and growth in dividend payments. These companies are some examples of how dividends can be a reliable source of passive income. Dividends can be paid out in a variety of ways: quarterly, semi-annually, or annually, giving investors flexibility in how they receive their earnings. One of the best features of dividends is the option to reinvest them. Reinvesting dividends uses those payments to buy more shares of the same company. Not only does this increase the number of shares an investor owns, but it also boosts the growth of their investment over the long term. Over time, as the number of shares grows, so does the total amount of dividends received. This reinvestment cycle creates a cumulative effect, which can result in exponential growth of the initial investment. Over the long term, this approach can lead to a significant increase in the investor's net worth, allowing their money to work for them more effectively. Advantages of living on dividends. Many people want to generate passive income and look for different options, but the reality is that many of these alternatives require more work than they seem. For example, investing in real estate can yield good returns, but managing a property is not as easy as it seems. You have to find tenants, solve maintenance problems, and deal with periods when the property is empty, which can take a lot of time and energy, as well as generate quite a bit of stress. The same goes for those who decide to write a book or create an online course. Although they can generate recurring income, creating that content takes a lot of time and effort, and there is no guarantee that you will make money from it. Those who take the plunge into the digital world, creating blogs or YouTube channels, also have a difficult path, as it can take a long time before they manage to build a large enough audience to make the project profitable. Compared to all these alternatives, investing in dividend-paying stocks is much simpler and less demanding. With dividends, you receive periodic payments without having to lift a finger after making the initial investment. Additionally, companies that pay dividends consistently tend to be more stable and less affected by market ups and downs, giving you a little more peace of mind. To maximize your dividend income, it's key to diversify your investment. That is, don't put all your money into one company or one sector. This helps you reduce risk and have a more stable income stream. The stability and growth potential that dividends offer make them a very popular choice for those looking for income without having to work too hard. If you find today's content very useful, don't forget to give it a like and subscribe to the channel so you don't miss the next video. Let's continue. Write down your expenses. This process involves making a detailed inventory of personal finances, which includes both fixed and variable expenses. Fixed expenses are those that remain constant from month to month, such as rent or mortgage, utilities such as electricity, water or gas, and others such as insurance, health expenses, and those related to car maintenance. Fixed expenses also include debt payments, which can range from credit cards to personal loans. Variable expenses, on the other hand, are more fluctuating and include items such as food, transportation, entertainment, vacations, and clothing. Keeping track of these expenses over several months can provide a more accurate estimate of your financial needs. Additionally, it's important to consider how much you want to allocate to savings or reinvestments, such as an emergency fund or additional investments. Once all the expense information has been gathered, the next step is to estimate the total annual expenses. To do this, add up all the monthly expenses and multiply the total figure by 12. For example, if the monthly expenses amount to $3,000, then the annual expenses would be $36,000. This calculation is essential as it provides a solid basis for understanding how much income you need to earn from dividends. To calculate the required dividend income, it is crucial to understand the dividend yield rate of the stock you plan to invest in. The yield rate is calculated by dividing the annual dividend by the share price. For example, if a stock pays an annual dividend of $7 and its market value is $100, the resulting yield rate would be 7%. Using this yield rate, you can determine how much capital you need to invest to generate the required annual income. In the example above, if annual expenses are $36,000 and the yield rate is 7%, you would need a little over $500,000 of capital invested in stocks offering that yield to cover your annual expenses. While this may be a fairly high return, the truth is that stocks with this type of return exist and in abundance. For example, in August 2024, the dividends of the transport company Euronav yielded more than 38% annually, while other energy companies such as Petrobras and Ecopetrol yielded more than 15%. It is vital to note that dividend income may be subject to tax, depending on the tax laws of the country where you reside. Therefore, it is advisable to adjust initial estimates to include these taxes, which could result in the need for additional capital. Projections also need to be reviewed and adjusted periodically. As expenses, dividend yields, and market conditions change, the initial approach may need to be recalibrated. Consistently monitoring personal finances will help ensure that dividend income continues to be sufficient to cover all necessary expenses. Therefore, we can say that living off dividends is an achievable goal, but it requires careful analysis of expenses, a clear understanding of investment returns, and a proactive approach to investment management. Now, the next question we must face is, what kind of stocks should we buy if we really want to live off dividends? The key to living off dividends is understanding the different investment options, such as traditional company stocks, high-yield stocks, ETFs, or REITs. Each option has a different impact on your long-term income, depending on your risk appetite and financial goals. Traditional companies with low dividend yield. Companies like Coca-Cola, Procter & Gamble, and McDonald's are iconic examples of companies that pay dividends on a regular basis. These companies are known for their financial strength and ability to generate consistent profits, making them safe options for investors looking for stability. However, the dividend yields they offer are often relatively low. A clear case is Coca-Cola, whose dividend yield currently hovers around 2.7%. This means that for every $100 invested, you get less than $3 in annual dividends. If your goal is to generate $36,000 a year solely from Coca-Cola stock, you would need to invest more than $1,300,000. For many investors, reaching a figure of this magnitude can be difficult, especially if they do not have decades to accumulate capital. These companies are valued for their long-term consistency and their ability to increase dividend payments over time. Although their initial return is not so high, the security that these stocks provide is a key factor when it comes to building a volatility-proof portfolio, making them pillars within any dividend-based investment strategy. However, for investors who are just starting out or have little capital available, these large, low-yield companies are not the best option. In these cases, it is worth considering stocks with a higher dividend yield, which, while they may be a little more volatile, allow you to generate passive income with a smaller initial investment. Companies with the highest dividends. Therefore, for those who do not have such a large capital and are looking to obtain income more quickly, there are companies that offer higher dividend yields, although they often entail greater volatility. Something to keep in mind is that in these cases, it is key to carefully evaluate each option. A good example is Goldman Sachs BDC, which currently offers an attractive dividend yield of 12.48%. This company is a subsidiary of Goldman Sachs, specializing in financing small and medium-sized growing companies through loans and other forms of capital. Acting as a business development fund, it focuses on generating stable income, distributing most of its profits to shareholders in the form of dividends. With the dividend yield offered by this company, the investment required to generate $36,000 per year is significantly reduced to $288,000. Investing in a high dividend-yielding stock may seem like an easy option, but it comes with risks, so diversifying your portfolio is essential to minimize losses and increase the chances of long-term success. Therefore, it is advisable not to put all your capital in a single stock, but instead spread the risk across several companies or sectors. REITs, real estate investment trusts. Another attractive option for investors looking for high dividends are REITs. These are companies that own and operate income-producing properties, such as apartment buildings, offices, and shopping malls. REITs are required by law to distribute at least 90% of their income to shareholders, making them an interesting option for those looking for passive income. For example, Realty Income, which has a dividend yield of just over 5%. In this case, you would need to invest approximately $679,000 to generate $36,000 annually in dividends and cover all expenses. Although REITs tend to be more volatile than traditional stocks, they can offer more attractive returns over the long term. ETFs. Finally, a popular strategy among dividend investors is ETFs, which are mutual funds that group together a variety of stocks and allow you to easily diversify your investment. These funds are ideal because instead of investing in a single stock, you can get a basket of stocks that pay dividends, reducing the risk of losses. A prominent example is the Invesco ETF, which offers a dividend yield of 4.09%. With this ETF, you would need to invest approximately $734,000 to generate $36,000 annually in dividends. While this ETF does not have as high a yield as others, its focus on companies that consistently increase their dividends makes it a safe and diversified option. In short, living off dividends is a passive income strategy that can offer long-term financial stability and freedom. The minimum amount you need to achieve this will largely depend on your living expenses and the companies or funds you invest in. While some strategies require a large amount of capital, others can make this goal more accessible. Do you recommend any dividend stocks that we haven't mentioned? Leave your feedback in the comments. If you enjoyed today's video, don't forget to give it a like and subscribe to the channel so you don't miss out on future content. See you next time.